It began with a dream, a glowing screen, a dial-up tone, and the promise that technology would change everything. In the late 1990s, the internet was more than a tool. It was an idea so powerful that it made people forget gravity. A new economy, a new frontier, a new world. That was the promise. For the first time in history, a generation of investors believed they had found a way to escape the old rules of business. Profits didn't matter. Earnings didn't matter. Only clicks, traffic, and potential mattered. The future, as the headline said, was online. But by 2001, that future was bankrupt. To understand how an entire era lost its mind over pixels and promises, we have to go back to where the illusion began, the 1990s. The Cold War had ended. The United States stood unchallenged as the global economic power. Inflation was low, unemployment was falling, and personal computers were invading homes and offices at an unprecedented pace. The World Wide Web, launched in 1991, turned static machines into a network of infinite possibility. For the first time, anyone could publish, share, or sell to anyone else, anywhere in the world. It felt revolutionary. Capital markets, still euphoric from the longest bull run in history, were desperate for the next big thing. Silicon Valley, once a quiet cluster of hardware firms, became the epicenter of digital gold fever. Venture capitalists, led by names like Kleiner Perkins and Sequoia, began pouring billions into startups that existed mostly on ideas. Between 1995 and 1999, investment in internet companies exploded from $1 billion to over $40 billion. A teenager with a website could raise millions overnight. The language of innovation replaced the language of caution. First-mover advantage became gospel. Profitability became obsolete. At the center of the storm was a perfect alignment of technology, policy, and psychology. The U.S. Federal Reserve, under Alan Greenspan, kept interest rates low, fueling cheap credit and speculation. Deregulation in telecommunications opened floodgates for new internet service providers and e-commerce platforms. Online brokers like ETRADE and Ameritrade made it effortless for ordinary Americans to buy and sell stocks in real time. The stock market, once dominated by institutions, became a playground for millions of first-time investors who believed they were part of a revolution. The Nasdaq, the index tracking tech companies, became the thermometer of this fever. In 1995, it stood at around 750 points. By March 2000, it had reached 5,048, a 600% increase in 5 years. Companies like Yahoo, Amazon, and Cisco were household names, while others like Pets.com and Webvan became symbols of futuristic optimism. The rules of business seemed rewritten. It didn't matter if you made money today. All that mattered was that someday you might dominate the internet. Investors didn't want value. They wanted growth, and growth was measured in imagination. IPO mania took over Wall Street. Hundreds of startups with no profits and barely any revenue went public. On the first day of trading, many doubled or tripled in value. CEOs became celebrities. CNBC ran non-stop coverage of tech stocks, and magazines featured young founders as the new industrial titans. Every taxi driver, dentist, and college student seemed to be trading shares. The economy itself appeared to have transcended its old cycles. Pundits called it the new economy, one driven not by factories or oil, but by code and connectivity. But under the surface, the math never worked. These companies were burning cash at unsustainable rates. Many spent millions on advertising, office space, and branding just to grow faster than competitors. Venture capitalists, eager to cash out before reality caught up, pushed startups to go public as soon as possible. Analysts, afraid to miss the boom, gave sky-high ratings to obviously failing firms. The same media that had once asked hard questions now worshipped innovation as an ideology. And the Federal Reserve, watching from above, hesitated to intervene. Then came the turn. In December 1996, Greenspan warned of irrational exuberance, but the markets ignored him. The real pain began in March 2000. The Nasdaq hit its peak, 5,048, and then began to fall. At first, investors dismissed it as a correction, but within weeks, the selling became a stampede. Venture capital dried up, IPOs were canceled, and once celebrated startups collapsed. In 1 year, the Nasdaq lost more than half its value. By October 2002, it had fallen nearly 80% from its peak. Trillions of dollars in paper wealth vanished. Pets.com, famous for its sock puppet mascot, went from a $300 million valuation to bankruptcy in 9 months. Webvan, which promised to revolutionize grocery delivery, burned through $1 billion before shutting down. Dozens of other companies disappeared without a trace. Even giants like Cisco, Intel, and Oracle lost more than 70% of their market value. Amazon stock fell 90%. Overnight, the digital utopia turned into a wasteland of unpaid bills and broken dreams. The human cost was enormous. Over 100,000 tech workers lost their jobs in 2001 alone. Silicon Valley's office parks emptied, venture funds froze, and the culture of limitless optimism turned to fear. The U.S. economy slipped into recession. Pension funds that had invested heavily in tech stocks suffered huge losses. The same media that had celebrated the boom now mocked its excess. The Internet, once a symbol of freedom and innovation, became a cautionary tale. Yet even in the wreckage, seeds of the next revolution were being planted. Out of the ashes of failed startups emerged a new generation of survivors. Companies like eBay, Amazon, and Google, which learned from the mistakes of their predecessors. They built real business models, generated profits, and transformed the Internet from speculation into infrastructure. The bubble had not destroyed the digital revolution. It had purified it. But the deeper lesson of the dot-com crash wasn't about technology. It was about psychology. The illusion that the future could be bought, traded, and monetized overnight revealed a universal pattern. Every era believes its innovation makes it immune to collapse, that this time is different. Yet history shows that progress always comes with leverage, and leverage always comes with risk. By the mid-2000s, the same patterns had reappeared, this time in real estate and financial derivatives. The 2008 crisis, though born from mortgages, followed the same logic. Too much money chasing too few real opportunities, inflated by belief and greed. In the 2020s, it resurfaced again in cryptocurrencies, NFTs, and speculative tech stocks. Once again, the narrative of limitless innovation overshadowed the arithmetic of profit and loss. The tools change, but the human psychology does not. The dot-com bubble stands as the digital generation's version of the 1929 crash, a story of how technology, hype, and money collided to test the limits of trust. It wasn't the Internet that failed, but the belief that value could exist without reality. The crash reminded the world that progress doesn't erase gravity. It only hides it for a while. 3 truths endure from that era. First, innovation is not a business model. It needs substance to survive. Second, markets can ignore fundamentals longer than logic allows, but never forever. And third, Every bubble, no matter how new its disguise, is built on the same fragile foundation: belief without balance. The future didn't end in 2001. It was just delayed until it could stand on real ground. But the next illusion is already forming in artificial intelligence, green tech, and digital currencies. The same story, the same temptation. The belief that this time, the future won't go bankrupt. If this story made you see the digital age differently, subscribe to Economic Collapse. Because history's next crash won't come from ignorance. It'll come from the same brilliance that once thought it could never fail.